We have a special guest with us. It's David Sachs. He is the founding CEO and product leader of PayPal, founder and CEO of Yammer. And in 1995, he and Peter Thiel co-authored The Diversity Myth, Multiculturalism, and the Politics of Intolerance at Stanford. And he currently co-hosts the podcast All In. Welcome to the show, David Sachs.
Hey, good to be with you, Jimmy.
So the reason why I have you on is because of the bank failures that happened, and you've been outspoken on it. And so I just want to give a little background, and then we'll bring you on and get your comments. So Tucker Carlson had a lot to say about this. He had this. I just want to show a little 2-minute of what he said.
What happened next is very simple. Wall Street was allowed to privatize its gains, but socialize its risks. That meant if things went well, the finance people got rich, in fact, richer than any group in human history. But if things went south, the government, would swoop in to save them. Pretty good deal. But for more than a decade, very few complained about this arrangement because things went very, very well. Wall Street boomed. And the root of Wall Street's success, no matter what they tell you, was low interest rates. Not new innovation, low interest rates. Low interest rates make a bull market inevitable. So in a normal, non-distorted capitalist economy, companies become valuable, more valuable, when they produce more goods and services that people want to buy. But in an economy controlled by monetary policy run by the Federal Reserve, companies become valuable when interest rates decline. So for 13 years, interest rates remain near zero. In retrospect, now that it's ended, this was crazy behavior. These were emergency measures declared by the Federal Reserve after 2008, but they never ended. And because they never ended for 13 years, the American economy was distorted beyond recognition in ways too numerous to count. Venture capital and private equity exploded. So did cryptocurrency. So did asset prices, particularly real estate. There was an ocean of money flooding the system. And the people who pay half the tax rate you do benefited most. They started buying third houses and flying private. But there was also a problem that you didn't hear a lot about with low interest rates. If interest rates are at zero, how do you get meaningful returns on your money? This was a problem that virtually every investor faced for more than a decade, very much including the banks. At some point, investors became tempted to make very risky bets. If they wanted to produce returns, they had to. As they say on Wall Street, Tina, there is no option. One of the risky bets that banks made was loading up on long-term treasury bonds from the U.S. government as a surrogate for cash, though, of course, bonds are not cash. They're different from cash, as we're now learning. But that worked fine as long as interest rates remained low. But once interest rates rose as a response to inflation, as obviously they were always going to do, nothing lasts forever, including zero interest rates. Once that happened, those bonds were worth less than the banks had paid for them. And so the banks began to fail. You are seeing that right now.
So let me bring in David Sachs. So do you agree with what he just said? Is that basically what happened?
Yeah, basically. I mean, I don't think it's got everything in it because what's happening here is complex, but I think that Tucker is largely correct. We had the zero interest rate policy or the ZIRP for far too long. It was an emergency measure that started with the great financial crisis, and somehow it just kept going and going. But I think that there was phases to it, Jimmy. And I think the worst part of it really was in 2021 when we started to see clear indications of inflation. Remember, by that summer, we got the shock inflation print of 5.1%. And the administration, it was Yellen and Powell and Biden, they all said it was transitory. So they denied the evidence in front of our eyes. Now, it's one thing to keep interest rates low when inflation is very low because you don't need necessarily to raise rates. But once inflation started spiking, it was really clear that they needed to start raising interest rates. And they did the opposite of that. Not only did they not raise interest rates till I think it was around November. So again, we started to get the warnings in May. No hikes until November. They said it was transitory. It wasn't. And they kept doing QE all the while. So, over 100 billion of additional QE so they were printing more and more money and pumping into the system. And that is what created a huge asset bubble in the second half of 2021. So yeah, the whole ZIRP and QE thing was crazy though, and as long as it did. But what happened in 2020 and 2021 was the most sort of frothy, manic period of that bubble.
So the CARES Act was a $5 trillion upward transfer of wealth. It's the largest upward transfer of wealth in human history, and they did it under the guise of helping workers, which is just. And so, how much did that affect the inflation? So that had to be so. I mean, I'm a comedian. I'm not an economist,
Right?
but if you flood the market with $5 trillion, how does that not produce rising interest? I mean, inflation, right?
Yeah. So all this did begin. The sort of latest phase of easing began during COVID, where all of a sudden, well, remember we had this COVID swoon in Q2 of 2020. Where if you looked at the year-over-year numbers, it looked like a 30% decline in the economy because of the lockdown, something crazy like that. I mean, it looked like we're headed into a Great Depression. And so the Fed and the federal government threw everything they had at that problem. They, printed tons of money. It was QE on overdrive. Rates were basically zero. And, they started doing all of these acts that, were basically COVID relief bills. We can debate the quality of those bills. I haven't looked that closely at what was in them. You're probably right about that. I wouldn't be surprised at all if the money didn't go to the right places. But I would tell you that I think that was the start of this thing. And so I think you can definitely lay blame in a bipartisan way. But I do think that when you then got into Q1 of 2021, that was a new phase because the economy had recovered. In fact, it was a pretty hot recovery by Q1 of 2021. And then Biden passed the American Rescue Plan, which was another $2 trillion of COVID relief along straight party lines. And you'll remember that Larry Summers at that time warned the administration, guys, I think you're taking a big risk here. This could really cause inflation. And, the administration sort of poo-pooed, said, oh, this is Larry being a troublemaker. And they disregarded it. And I think that was really the start of a whole new phase of problems. And then later that summer, when the inflation began to hit, I mean, it hit like 4 months later, again, that 5% print, they should have slowed down, but they kept going. I mean, foot on the gas pedal. We then had, over $1 trillion of infrastructure. We had the Build Back Better bill. You had the Inflation Reduction Act. You had the CHIPS Act. And so they kept spending and spending. And then at the same time, the Fed kept printing and printing. And so we entered a new phase of this thing where I think that just as the indicators were telling us, hey, we have an inflation problem, they didn't slow down. They kept printing and spending. And I think that's why the result of that, just to cut to the chase here, is that we've now, for the last year, had the most rapid rate tightening cycle I think we've ever seen in our lifetimes.
When you say rate tightening, you mean interest rates rising. Is that what you mean?
Yes.
Yeah.
Yes, exactly. So the Fed, they control the Fed funds rates, the overnight rate of lending to banks. They jacked that up from roughly zero to, close to 5% in a year. You just look at that chart and it's a very steep climb. Now, when you jack up interest rates that sharply, something's going to break, because the value of assets, whether they're bonds or stocks, are inversely correlated with interest rates. So the value of all those assets, especially bonds, goes down, gets clobbered. And then I think also on the deposit side at banks, if there are more attractive places to put your money, like money markets, you start seeing huge drawdowns in deposits. So the reason why the banking system is under so much stress right now is because of this rapid rise in interest rates. Again, huge outflows of deposits. At the same time, all those assets on their books that were supposed to be safe, like T-bills, like mortgage bonds, have suddenly become toxic. So you've got the perfect storm.
So just so people can wrap their brain around what we're talking about is so when you have low interest rates, when let's say when you raise your interest rates, so when they put their money in bonds, so as the banks put their money, you deposit the money in your bank, they take that money, they put it into bonds and mortgages, actually. They did that again, mortgage-backed securities over a long term at low interest rates. And so they're not mature yet, all those bonds. And so when the interest rates raise, people start taking their money out of the bank, and then they have to cash in those bonds to give them their depositors their money. The problem is those bonds haven't matured yet, so that's a loss for that bank.
Yes.
So when the bank has to go get that money to give back to their depositors when they ask for it, the bank is losing money. And now my question is, where are the goddamn regulators, right? So what, they're supposed to be regulators for all this stuff?
Yeah. I mean, I think partly they were asleep at the wheel. So here's the crazy thing is that the head of the FDIC testified on Monday of last week that banks were sitting on $620 billion of unrealized losses from these long dated bonds that you're talking about. And just, one small quibble I would have with your description, although I think it's basically correct, is that the securities that were bought here were not supposed to be risky, right? 10-year mortgage bonds and 10-year T-bills, they're not supposed to be risky. They weren't considered risky by these banks at the time they bought them. Back in 2008, they were doing all those crazy derivatives, the collateralized mortgage obligations and all those crazy derivatives. Nobody understood what they were getting into. Those were genuinely risky assets that they lost control over. Here, the assets were supposed to be safe. And what happened is they got this sudden spike in interest rates, which basically collapse the value of them. And so you're right. And then there's the double whammy of deposits leaving the system because now the economy is slowing down and there's this general tightening of the money supply. So the bonds they got to sell, they got to go in the market and sell them to pay off the deposits that are leaving. And all of a sudden they're undercapitalized. And that's what you saw last week is on Wednesday, last week, SVB all of a sudden announces, hey, we need to raise billions of dollars. And that was reported by the Wall Street Journal on Thursday morning. And that's what led to the run on the bank, as everyone started wondering whether they were going to be insolvent or not. I mean, and there's all these conspiracy theories about how the run on the bank happened. It happened because people were reading the Wall Street Journal. When you read in the Wall Street Journal that your bank might need to raise billions of dollars because it doesn't have enough capital, it has all these unrealized losses, and now they have to realize them. Any normal person would try to take their money out if it doesn't cost them anything to do so. And that's why you had to run on the bank.
So there's more explaining to do, right? So I know if you're listening, like, you're not really following, it's hard to follow. I get it. It's hard to follow, but there's more to this. So this is an article, they want to blame the venture capitalists for this and the people who are doing business and startups, right? And to me, in my head, it would be the bank gave out too much goddamn money again that they couldn't cover, and they didn't account for that the interest rates would raise. And why wouldn't they do that? That's what they do for a living anyway.
Yeah.
So let me show you this article: the incredible tantrum ventures capitalists threw over Silicon Valley Bank. So a pandemic bull run inflated the value of tech startups and funds of investors, right? So the theory is that when interest rates are so low, people aren't going to put their money in the bank because there's no return on it. So they look for a place to get a return. And so they start putting in all these companies, and these companies become overvalued because of it, even though they're not producing a profit. Most of those Silicon Valley companies, that's the idea, right? So all this money goes into all these Silicon Valley banks. This Silicon Valley bank takes on all these deposits, right? Tripling of deposits at the regional bank that specializes in the industry's fledgling companies. So they went from $62 billion in assets to $189 billion at the end of 2021. So just in 2 years.
Right.
And so they put that money into U.S. Treasury and mortgage bonds, and that's supposed to be safe, and that would take years to mature, but serve as a relatively safe place part. As long as the interest rates didn't rise. They did rise, however, multiple times. Well, how in the hell did they not know that? So they just thought it was going to stay zero interest rates forever? Really? Is that what they thought?
They did. There's no question that SVB did a horrible job at risk management. Horrible. I don't know how that's VC's fault. The VCs are just one of many depositors at that bank.
Right.
Like any depositor, you want your bank to do a good job at risk management. They could have hedged the risk of interest rates going up, and they didn't. So they totally dropped the ball.
So this article goes on, and this is where it gets interesting to me. He says, So federal regulators spent the weekend invoking something called the systemic risk exception in order to get every depositor their money. Stockholders at the SVB will take a bath, and the institution's leadership were all fired. So if you're an investor in that bank, you're going to lose your ass, and all the management got fired. But if you have a deposit, you're going to be okay. And yet And yet you still saw famous venture capitalists like PayPal co-founder and Elon Musk buddy David Sachs begging the Federal Reserve to force a merger or a bailout, then insisting he was not asking for a bailout, while again asking for a bailout. Now, David, you didn't ask for them to take care of the investors, and you didn't ask them to take care of the management. You just asked them to cover the depositors. Is that technically a bailout?
I don't think so. I think when we think about bailouts, and this was certainly true in 2008, you think about basically the stockholders and the bondholders and the management of these companies. They screw up and then they get bailed out and saved by the federal government. I'm not advocating for that. I said that the stockholders should be wiped out, the bondholders should be wiped out, the management stock options should be wiped out. Becker, the CEO, he's going to be in litigation for years. He may have issues with his stock sales being clawed back. Who knows? Okay. I'm not defending these guys at all, but I do believe that I don't think depositors should take it on the chin. And it's not just about at SVB. I think it's really anywhere, and we can talk about that. But I don't think depositors should take it on the chin because of that. And, and I think by the time I was speaking out, I think it's important to note when I was saying these things. So I didn't tweet about SVB until they were already in receivership. And this was Friday afternoon.
And so you were being blamed. Some people on social media were blaming you for creating a run on the bank, but you didn't start tweeting about it until after it was already in receivership.
Yeah. They must think I'm Superman or E.F. Hutton or something, No, it was already in receivership, and the run on the next set of banks had already started, and I could see it because all my CEOs were scrambling to move their money out of other banks, not SVB, but other banks on Friday into what are called the SIBs, the systemically important banks like JP Morgan. We should definitely talk about that. But so I could see the run happening, and that was confirmed over the weekend when the feds basically took over Signature Bank in New York, and they basically stepped in and gave a backstop to First Republic Bank. And then, on Monday, even after the Fed stepped in a big way, you saw 20 regional bank stocks were basically getting hammered. PacWest, and there's a whole list of them. And so clearly there was a larger systemic issue here. And that's what I was speaking out about. I don't care about SVB per se. I cared about the health of the banking system. And I could see a banking crisis happening. And, when these things get going, they're hard to stop. Just look at the tape from the 1920s, the 1930s, before we had FDIC. You would see these runs on the bank, and people were literally, you could see photos outside banks. People were tweeting of people starting to line up to take out their money. So, I spoke out, I would say, in a concerned way about a bank run in progress that I saw. But the markets, the run had already started. And we didn't even talk about this on our pod until Saturday morning when all the banks were closed. So there's no way, Jimmy, that we could have caused this. This is like blaming, this is the old trick of blaming the person who notices the problem for causing the problem. I just noticed what was going on.
Well, they're definitely trying to blame you, because he goes on to say in the article, he says, you asking for a bailout, or what you were asking for, this may have seemed a bit strange considering you, Sachs's previous disparaging of handouts, specifically to Ukraine, and reactionary vitriol for liberalism itself. Boy, that is such a mixing of issues. I can't. Boy, oh boy, that is like oil and water. Those two things don't go together whatsoever. Your opposition to Ukraine funding is nothing. It's just nuts that. But they
Jimmy, let me show you how dishonest it was. They literally took a tweet that I wrote months ago about Ukraine, and my first tweet was about how the United States didn't have any obligation to be in Ukraine. It was optional because they're not a member of NATO and they're not a treaty ally. I think you and I may have some similar views on this. And so I said that, look, anything we do there is optional. And then the second tweet was basically that, that the federal government or any private company shouldn't feel obligated that we have to do something. Because that was at the time where they were trying to conscript Elon SpaceX into providing Starlink for free. Anyway, that was the context. So they took that second tweet and photographed it and started running it all over Twitter, saying that I'm against any handouts or whatever. And they're trying to make it sound like somehow that was a statement about banking issues. So it was just completely dishonest. And you can see it here in this article. They've at least added this parenthetical that it was about, but they didn't. That's a late addition. Jimmy is adding that parenthetical.
Okay, so I'm that's kind of like have an eye for that kind of stuff. But he goes on to say, but then again, Sachs, is a longtime associate of investor Peter Thiel, who believes in free markets but not in competition, in capitalism, so long as the rules are attuned to satisfy his own interests first and foremost. It was Thiel's Founders Fund, by the way, that helped kick off the bank run that sank SVB in the first place. Is that true, that last part?
I don't think so. Like I said, I think anybody who could wake up that morning and read the Wall Street Journal knew that there was a huge problem. And then because of that, the founder did this public phone call. It's the famous "Don't Panic" call. That was just a total catastrophe, where he basically admitted that if everybody didn't hold hands and stick together and stay in the bank, that they could be insolvent. Well, he's basically just urging all the depositors to not panic as if it's their problem. Huh. Well, I mean, basically that's basically what triggered then the run.
Well, here,
so yeah.
Let me just run down this real quick. I want to show some of your tweets that explain it. So you did a thread about this, which is what made me get the idea to invite you on the show. You said its collapse was first and foremost a result of its own poor risk management and communications. It should have hedged its interest rate risk. It should have hedged its interest rate risk, and it should have raised the necessary capital months ago through an offering that didn't spook the street. So what he's saying is that months and months ago, they should have seen this coming, and they should have known that their depositors were going to want to take more money out than they had, and they were going to have to start cashing in bonds that hadn't matured yet, so they were going to lose money in that situation. So instead of doing that, they should have went out and raised money, and they should have been able to see this coming. But of course, I guess the bankers are the dumbest peoples in the world every 12 to 15 years. So SVB doesn't deserve a bailout. So there you are, just plainly saying it. The SVB doesn't deserve a bailout and isn't getting one. SVB stockholders, bondholders, and stock options are getting wiped out. The executives will spend years in litigation and may have stock sales clawed back. Anyone who thinks there's a moral hazard, isn't paying attention. Anyone thinks there is a moral hazard, right?
Well, basically, the accusation is that if the government does anything here, if it intervenes in any way, then you're creating an incentive for the next set of guys to do the same thing.
Oh, yeah.
And my point is, the next set of guys will look at what happened here. They're not going to want to imitate this. They're not going to want to imitate.
So there is
they're not going to want to be Becker or SVB. Exactly. Come on, that's a ridiculous argument.
But it's important to understand that SVB's failure didn't arise from risky startups doing risky startup things. It arose from SVB's overexposure to boring old mortgage bonds, which were considered safe at the time the SVB bought them. Perhaps this is why SVB had an A rating from Moody's and had passed all of its that goddamn ratings thing is always rigged. That's the same thing last time. The banks finance the rating firms, and the rating firms give the rating that the bank wants them to get, and so it's worthless. I don't understand why we still have these rating firms and why the people at the rating firms didn't go to prison in 2008. Well, I know exactly why nobody went to prison. I'm sorry. What turned the mortgage bonds toxic? So what turned those bonds that they put all their money in, those long-term bonds, the most rapid rate tightening, meaning interest raising cycle we've ever seen in decades? You can see the connection here between the rapid. I'm sorry. I should have had that graph. So what caused the rapid rate hike? What caused the interest rates to spike? The worst inflation in 40 years. And what caused that? Profligate spending and money printing coming out of Washington, all while Biden, Yellen, and Polisher. So that's what we're talking about. The CARES Act, that $5 trillion. Then they did another $2 or $3 trillion the next year. And so they just printed it and threw that money into the economy. And by the way, they didn't put it in the pockets of workers, which is what FDR did, which is why his program worked and why this didn't. Okay, here we go. I warned 2 years ago that pumping trillions of dollars of stimulus into an already hot economy was was an unprecedented and likely dangerous experiment, but this was Biden economics. So when Joe Biden says he's going to hold those responsible for this mess fully accountable, he ought to start by looking in the mirror. But I'm sure that's not going to happen, just as I'm sure the hunt for scapegoats is just beginning. The stupidest part of all this is that Republicans are letting Biden off the hook by blaming depositors just because they don't like these particular depositors. That won't be a good look if more banks fail. The right position is no bailouts for banks, but protect deposits. So, why do we have that rule of only two? So I think that helps explain everything. That was a very good thread. I think I tweeted out. I forgot to put this in. No, I tweeted out Thomas Massey. Do you? I wish I had it to show you. I'm so stupid I didn't put in. Do you remember what he said? And then
I don't really understand it. It just I respect Massey. He's great on a lot of issues, a lot of things. But this one, I couldn't quite grok what he was getting at.
I'll read it. Let me read it. I have it. He says, the last 5 days simplified. A group of wealthy speculators got upset that their money ended up locked into a 10-year obligation at less than 2% return. So that means
who's he talking about?
Is he talking about the bank?
Who's he talking about?
Because the bank had their money in the bonds and mortgage. That was at a low interest rate, that 2%. That's what he's talking about, right?
Let me tell you, VCs are in the VC business to make 50 times their money. They don't care about a 1% or 2% interest rate. I mean, seriously, this is just way off base.
So they convinced government it was in everyone's best interest to help them out of their jam at the expense of everyone else. Now, I understand why bailing out people who have deposits in a bank above $250,000, because that's what you're guaranteed. Now, if I put my money in a bank and the bank collapses, the FDIC will insure me up to $250,000, so I don't have to worry. And that's so we don't have runs on banks, right? But we have that in place, and we still had a run on this bank because people had way more than $250,000 in that bank. So why do they let themselves be exposed like that? Wouldn't they spread it out? And two, why do we have that limit if we just break it whenever we feel like it, right? So now they're going to take care of people who have millions and millions of dollars in that bank, right?
Yeah. So here's the thing. I think the thing to understand about SVB is it keeps getting portrayed as some sort of like rich fat cat bank. It's a business bank. Okay. There's a lot of these sort of commercial banks out there, and their customers are mostly businesses. That's why the $250,000 is not sufficient. I mean, look, I'm all in favor of FDIC, but 250 is more of an individual threshold. You've got businesses, and they don't have to be like mega big tech corps. They can be small 10-person to 100-person companies. Some of them are tech startups. I had a school, a nonprofit high school in New England that was a SVB customer because SVB actually had a nonprofit division. And they emailed me saying, thank you for speaking up about this because our deposits would have been frozen in there and wouldn't be able to pay our teachers. There was a lady who is the CEO of a 15-person company, small business in Columbus, Ohio, who is tweeting, listen, I drive a Honda and I wouldn't have been able to pay my employees if we were frozen. So this is not just fat cats. There were 40,000 small businesses at this bank. 10,000 of them were in danger of not making payroll. That's why they needed to get their deposits unfrozen. So, fundamentally, my view is that we need to do everything we can to make depositors whole. Now, in terms of the 250, every time one of these things happens, Jimmy, we do generally make depositors whole because we realize the 250 doesn't make sense. So when WAMU went under, they placed it with JP Morgan Chase and all the depositors were made whole. Even Powell, you go back to the savings and loan crisis all the way back in 91. He has statements about how they made depositors whole in that situation, even though it exceeded FDIC. So there's precedent here for going beyond FDIC. And just the reason why 250 doesn't work for businesses is because what if you got a payroll or payables at the end of the month and it's a couple $1 million? Just 250 is not enough. What if you got a letter of credit for a couple $1 million that you need to give to your landlord? So you got to keep a couple $1 million in the bank. I mean, it's just not really realistic for business banking. And I think one of the things that needs to come out of this whole thing is we just update that. I think one of the things I said really early was, why don't we have like a business class of FDIC? And so it makes it make sense for businesses. And, everyone pays into all the banks will pay into that insurance. Doesn't come from taxpayers. And that would be a better way to handle this.
So it's coming from the money that banks pay into the FDIC, which insures deposits.
Yeah, that's an important point. Is
this is unlike 2008.
Yeah, exactly. So what's going on here is, like we talked about, stockholders management, the corporation kaput, they're done. Depositors made whole with a guarantee from the FDIC, which is an insurance fund that's paid into by premiums from other banks. So as far as we know, what they're telling us today is no taxpayer bailout. So that would be good. Now, we don't know exactly what's going to happen, but I think there's a good chance that will actually be what happens here, because I think when I've seen different analyses around SVB's balance sheets, and there's a lot of people arguing that they weren't that much in the hole. So, it might be 100 cents on the dollar, might be 95 cents on the dollar, 90 cents on the dollar. We don't know what's there, and we're not going to know what's there until they liquidate the whole portfolio. But the reason why it was so necessary to give these depositors protection is because they can't sit around waiting until they liquidate everything and figure out what's there. All these businesses had a payroll run on Wednesday, and they're going to have to start doing layoffs and furloughing workers. And, if they didn't get access to their funds. And so that's why it was such a crisis. And honestly, I just find it incredibly callous the way that I think some of these political opportunists, one of whom I debated, has a farcical idea of running for president. I mean, they're trying to excoriate these depositors as being, fat cats, when, look, there were VCs who banked there. There's also a lot of small businesses. I think it's just vindictive the way they're carrying on about this.
I don't understand. Honest to God, there's no bigger lefty than me, and nobody hates the bankers more than me, and the government, and the people who pull the strings, the big depositors, people like you. And but I just don't get why they would be angry at the small businesses.
Because they probably don't know.
And so
they know what's going on. I don't even think they believe it. They're just trying to rile people up.
So, I mean, this is obviously, again, another failure of bank regulation, and these bankers were just shit. Anyway, so this guy, Joe Nocera, says this. So after your Twitter thread, he says this. So I'll give you a chance to respond. It says, after your Twitter thread, he goes, in which David Sachs takes time off from his day job, funding companies to deflect blame because he and his ilk almost lost some money because they had uninsured deposits, including blaming Washington, which saved their ass. That is the definition of chutzpah. Now, so did you have money in SVB?
I did not have money at risk. Some of my portfolio companies did, but I don't mind defending them because I think they should get access to their deposits. That's their money. But no, I was not at risk. We did business. We had a number of banks that we had relationships with, including SVB, but we had our money out before this whole debacle and the receivership.
Okay. And so a guy like this, so there's a big faction of people, David, that are against stopping the bank run and stabilizing things and making sure depositors things are covered. There's a group of people who think that's bad.
I don't even know if they really believe it. I feel like they're just trying to use people like me or VCs as a punching bag. I think, I don't know if it's because, look, I was the only guy in Silicon Valley who spoke out against the deplatforming of Trump. I believe in free speech. The media does not. I spoke out about us getting involved in World War III in Ukraine. The media loves that cause. So listen, I think they'd love to come after me for anything. But so I don't even know if they really believe this stuff or whether they're just making it up as to try and, come after me. But let me tell you, but Jimmy, let me tell you, there's another angle to this whole conversation, which is let's discuss what would have happened if the Fed didn't step in. And by the way, just because I think the Fed did the right thing on Sunday night doesn't mean I can't blame them for the things they did wrong in 2021. Both can be true. They did the right thing one night. They did the wrong thing for 10 years. Any event, what would have happened, what I saw happening on Friday with all the money flowing out of banks, I can tell you where the money was going. It was going out of regional banks and it was going into top 4 banks.
Yeah.
Because what happened in 2008, remember when they had this whole too big to fail thing? What people don't understand is they actually canonized too big to fail. So it wasn't just this one-time thing. They actually wrote it into law, and they, instead of calling it too big to fail, they call it systemically important bank, a SIB, S-I-B. And there's 4 systemically important banks. They're the $1 trillion club. They have over $1 trillion in assets. And everybody who's below that, the kind of the regional banks, they're not systemically important. So what does that mean? The Fed has basically guaranteed everything in the SIBs because they've said that, listen, we can never let one of these banks go down because it'll take down the whole financial system. So this is what everyone was talking about on Friday. They're like, oh, wait a second. If the Fed is going to protect the SIBs, but not protect all these regional banks, why would I ever put my money in a regional bank?
Right.
And it wasn't just SVB was done at that point. It was First Republic, and it was PacWest, and it was 20 other regional banks who were under massive stress, and all the money was leaving, and they're going to Jamie Dimon. And I kept saying, you know, the person who's licking his chops over this whole thing, who doesn't want to bail out of the regional banks, is Jamie Dimon, because he manages JP Morgan Chase, the biggest bank. So I don't get all these like would-be populists who think they're being helpful here. All they're doing is being useful idiots for the big 4 banks, because without the government intervening to solve the mess that they created, all the cash would be going to the top 4 banks. And my view is we need a vibrant regional banking system in this country, because if you don't have that, our freedom is going to be greatly curtailed. I mean, you talk about the risk of a social credit system. The easiest way to have a social credit system would be to force everyone's money into 4 banks, and then they can just implement the system through their terms of service. And who runs these 4 banks is always people who are politically connected in Washington and Davos. In fact, there's a special version of the SIBs that meet in Davos called the G-SIBs, the global systemically important banks. I mean, you can't make this stuff up. It's institutionalized. The only way to push back on this is to have a diverse set of regional and community banks. And this is what you have. This is how you have to see. There's only 2 teams to be on here, Jimmy. You can be on Team SIB or Team Regional Bank. I'm on Team Regional Bank. And I'm sorry that some people don't like that some of the depositors of one regional bank were people they don't like, but we got to see the bigger picture here.
Well, what about nationalized? Shouldn't there, it's like, you know, I think North Dakota they have like a government and a state bank. And I know in California, there was a push to have that. And those banks, you know, tend to not be corrupted. What's your view on those? And go ahead.
Well, I always feel like, you know, if you're talking about nationalized, I feel like the situation we have right now with the SIBs is they're semi-nationalized. There's such a cozy relationship between those banks and Washington. And so I don't know exactly what the right answer here is in terms of future banking regulation. I'm open-minded about what we need to do. I'm willing to listen to Elizabeth Warren. She says that these regional banks need to be more tightly regulated. I'm open to hearing her ideas. You know, I'm open to hearing, you know, do we increase the premiums that these guys pay? I mean, I want to hear, but basically I do think we're going to clean this up, and there may be more regulation on these banks, but I just want there to be a vibrant regional banking system. That's the bottom line.
So Trump repealed the Republicans, and with the help of course, top Democrats in the Senate, repealed some banking regulations that let this happen, right? That's the narrative. That's definitely the narrative that's coming out. And I don't want to, I haven't dug deep on what happened in 2018. So I don't want to say conclusively, but that's what Elizabeth Warren says. And that's what, Ro Khanna says. Yeah. And Joe Biden says that. And my point is, you've had control of government for 2 straight years. Why didn't you put those regulations back if you think that's what did it? And of course, we all know the answer is that Joe Biden and Kamala Harris work just as much for the big banks as the Republicans do. That's why it's a uniparty, and that's the problem. It was
bipartisan.
Yes, of course. It always
in
is.
2018.
Just like the war policy, banking policy. So let me just show you this. I wanted to let you know we were busting your balls the other day, because you said down here in like 2009, right? You said the problem with socialism is that eventually you run out of other people's money. And then here you were asking the government to bail out depositors. And so how do you reconcile those 2 things?
Well, I mean, just because I believe the federal government has a critical role in preventing bank runs doesn't mean I want socialism. I mean, those are two different things.
Isn't that socialism, though? Isn't that socialism? No.
No, here's where I disagree. I think we figured out in 1933 that the only way to stop bank runs is to have the federal government step in. I mean, like, I've never disputed that. If you go back, Jimmy, to the 1800s, 1920s, we had bank runs all the time in this country. It was a constant panic happening. And the reason for that is because the game theory of a bank run is compelling. What basically happens is if you hear a rumor that the bank might be going under, you can potentially save all your money by taking it out and you lose nothing by leaving it in. So anyway, I don't want to go on too long, but the point is just, I think there is an important federal role in preventing bank runs. So does that make me a socialist? I mean, I don't think so, but you tell me.
A little bit.
Well, then maybe we're all evolving, and that's okay.
It sure does. Well, what they say is that what is the saying? It's rugged it's socialism for the wealthy and rugged individualism for everybody else, and that's certainly what it's looked like in this country for the last 20 or 30 years. And certainly in the first banking crisis, Barack Obama kicked 5.1 million families out of their house while he made sure the bankers kept their bonuses, and that's why the Wall Street gave more money to Barack Obama than they did to his Republican opponent, because he was hand chosen. They knew he was their man, and they tried to get Kamala Harris. She was the biggest simp to the Wall Street, but no, she couldn't get a vote in the primaries. So then they went to Joe Biden, their next most reliable enemy of the people and the workers. And so now we have two completely captured Wall Street tools running our government, but of course they're not running. Yeah. Everybody knows Joe Biden's not making any decisions. I wonder who is. But anyway, David, is there anything else you'd like to say before we say goodbye?
No, I think we covered everything. Appreciate the chance to come on your show. I'm a fan of yours on many issues.
I think
you present them with a lot of panache.
I appreciate you saying that. Our interests certainly align over Ukraine and free speech. Go to jimmydore.com to see my new stand-up special, COVID Lies Are Funny. For only $10, you get to become a premium member too. And come see us do our live shows. We're going to be doing stand-up comedy in Milwaukee, Nashville, Honolulu, Los Angeles, Northampton, Massachusetts, Syracuse, New York, Cohoes, New York, Hartford, Connecticut, Baltimore, Maryland, and more. Go to jimmydore.com for a link for all those tickets.